Well, when you think about the leaders in deploying generative AI, probably the big tech companies come to mind. Do you think about retailers? Our next company has got customers like Lululemon. Adidas is one of its top backers, and it is laser focused on deploying generative AI as a solution to some of these retailers. Let's bring in Michelle Bacharach. She is the CEO of FindMine, and she joins me now. Michelle, thank you so much for joining me. First, let's talk about what your technology enables for these retailers.
Yeah, so I'm based in New York. It's the Met Gala today. I look at the red carpet of the Met Gala and I say, wow, that's super inspiring, but also pretty intimidating. And a lot of consumers like myself feel intimidated when it comes to fashion, home, beauty, being the most stylish version of ourselves. The brands and retailers we buy products from, they have great inspiration for us. It's in the window display, it's in the mannequin, it's in an ad campaign, but it's typically only available for 5 or 10% of the products that they sell. So what FindMine's AI does is we take that style inspiration they're already doing and we scale it across the whole catalog. So every product can appear in a styled moment to over 100 million consumers each month.
So practically speaking, that means what? If I like a sweater on a website, then the AI will say, well, this also fits with like 4 other items that would go with that sweater?
Yeah, it's literally prescribing you how to wear it to look good for a specific occasion. If it's in the athleisure space, it might be how to wear it to perform your best at yoga or tennis, really just how to be successful with the product and feel like the best version of yourself.
And previously, I imagine that would be done by stylists. But to your point, if you've got a catalog of more than several hundred items, it's hard to do that just as one individual.
Exactly. And that's why a lot of people will say like AI is coming to replace jobs. And there's a lot of areas where that's true. Our specific application of AI is actually doing what there weren't any people in the first place to do because they have their hands full with that 5 or 10% of their products and have to cherry pick which ones are going to get that love and care, which leave consumers without the inspiration for the rest of the product catalog. And that's really the gap that we close.
I mentioned that you've got some big customers like Lululemon and Adidas. You also have a little bit, some niche ones like Anina Bing. And I'm curious, what it takes to convince a retailer to spend on tech. This is a notoriously thin margin business. Are you finding that, maybe post ChatGPT, retailers are more willing to spend on these innovations?
Absolutely. And in fact, we work with the Rogers Media Company's property TSC there in Canada, and they were such an early adopter of AI technology. And what we were able to do for them is actually increase the amount that shoppers are spending. So when they first launched FindMine, they saw a 3% increase in revenue right off the bat. So with AI technologies, as long as it works and helps pay for itself and achieves, a 10x, 20x, 30x ROI, even in a business where margins are low, if you can help them achieve results that are impactful to their bottom line, they are going to, adopt it very quickly, especially with the comfort level increasing every single day as many of us are interacting with these, ChatGPT and the like in our everyday lives.
I'm really curious about how the AI learns what's cool. I mean, I'm struggling still to figure out what's cool and ask, really, are capri pants back? Are you sure? And so how does the AI sort of learn, take in a brand's whole style catalog enough so that they can recommend? It seems so intangible.
It's highly intangible. That's a great way to describe it. Brand is kind of this je ne sais quoi that you don't know what it is. You can't even describe it. So the language, the human language required, if you were a person who worked in a brand in a creative capacity and you sat down, you cracked open, one of these large language models and you tried to express what it is to be that brand, you might not even have the language for it. The way FindMine does this is we have proprietary data sets, we have proprietary AI models, and then we blend in some of the AI large language models that are available off the shelf from companies like OpenAI or Google. Meta has their own. And then the reason that we pull those together is that the proprietary stuff that FindMine does is actually mapping brand in multidimensional space. So it's this idea that the computer can understand based on 60,000 different attributes what goes into what that brand is. And then we can create assets based on that are true to the brand, but then that people don't have to be heavily involved in the replication of that asset at massive scale.
Welcome back. Food delivery company Instacart is partnering with Uber, the giant of the rideshare business and the food delivery business, to offer restaurant delivery through the Instacart app. This is taking on the top U.S. food delivery app, DoorDash. For more on this, we're joined by Bloomberg's Natalie Lung. Natalie, thank you so much for joining us. Tell us about the basics of this deal.
Right. So Instacart is working with Uber to basically integrate the Uber Eats interface to integrate restaurant delivery ordering within the Instacart app. And Instacart will be getting an affiliate fee from Uber for every order it passes on to Uber Eats. And for Uber, this basically allows them to tap into the suburban and family-centric user base that Instacart has built up over the years.
How fundamentally different is it than Uber Eats, which also, of course, offers delivery from restaurants?
Right. So for a customer perspective, within the Instacart app, basically it looks the same as Uber Eats. But then, of course, obviously, you're able to do that within the Instacart app. And for Instacart monthly subscribers, you get a free delivery if the order is over $35. So they want the experience to be the same as Uber Eats. And for restaurant merchants, they won't be able to tell if the customer is from Instacart or from Uber, because basically all orders will be funneled through Uber Eats.
Interesting. You refer to Instacart's customer base as being suburban families. Tell us more about that.
Right. So Instacart started as just a grocery delivery business. And during the pandemic, when people were locked down, a lot of that habit was built up to do the weekly grocery run on the Instacart app. And so a lot of their suburban families that really use this app for their bulk grocery purchases. And so they're still a market leader in the bigger basket purchases. And it's different from DoorDash and Uber Eats, who also have their own grocery business, but they have more recently siphoned away some of the last minute, like one-off purchases from Instacart.
I didn't realize that DoorDash had such a commanding position in the U.S. food delivery market. Bloomberg itself estimates that share to be 67%. Tell us about that, and how much of that market share does Uber and Instacart want to strip away? DoorDash was 67% of the U.S. food delivery market.
Yeah, so DoorDash started as a restaurant delivery service, so they more than 10 years ago. So they have built up that user base and even the driver base. They have 7 million drivers in 2023, so that's markedly bigger than what Uber has. As you said, they have 67% market share. Uber Eats has around 23% based on the same data set. Otherwise, it's a Grubhub and other players in the restaurant delivery service. So by teaming up, they're able to go against one of the market leaders in the space.
One of the big stories we're monitoring overseas is the high-profile trip China's President Xi Jinping has made to Europe. It is the first such visit in 5 years, and it's designed to promote China as a bigger trading partner to European nations. That said, it comes at a time when we've seen growing tensions between Beijing and Brussels. Western European leaders have accused Xi's government of flooding their markets with cheap exports that threaten jobs. Xi's support for Russia, despite its war in Ukraine, has also thrown the relationship further off balance. David Oliver of the consulting firm Minerva Strategy has been monitoring the story closely. David often joins us to talk about geopolitical matters. Nice to see you.
Hi, John.
So the significance from your perspective of this trip by Xi?
Yeah, so this is a return trip, really. Macron went to China last year. We've just had Olaf Scholz visiting Beijing in April. And that also followed quite a bit of international diplomacy because, of course, Antony Blinken and Janet Yellen were also in China last month. Macron has positioned himself to sort of take the lead as being Europe's preeminent statesman, probably a little bit to the chagrin of Herr Scholz, but is trying to show that he is trying to lead the European sense of its engagement with China, with some of the big thorny issues they've got, particularly over trade, but obviously also with the war in Ukraine and China's relationship with Russia.
Yeah, so let's walk through that, because on the one hand, just the fact that Xi has made this trip is highlighting the fact that he sees the opportunity for more dialogue. And yet it's interesting here in North America, when we talk about the relationship with China right now, it is seemingly more complicated. You see a lot more focus on, build in North America as opposed to rely upon China. And you sometimes hear that same kind of messaging out of Europe as well, but I guess it's somewhat complicated.
A lot more complicated, not least because I think North America, there's a lot of intertwinement between the North American and Chinese economies and the global economies, of course. But I think there's a greater emphasis, particularly in the US, on decoupling from China, whatever we want to call it. Europe has that same sense, but I think there's a lot more intertwinement between a lot of the European companies, and particularly if we start to look at EVs, the amount of JVs there are between European companies and Chinese companies, particularly German ones. That's why Scholz was there in April. You start to see that some of those intertwined tentacles are much more complicated. Europe still has a $315 billion trade deficit with China, though, last year, and that was the second highest year ever.
Yeah, you could make the argument there are more points of agreement than disagreement in this kind of meeting, and yet you mentioned there are a lot of thorny issues as well.
Yeah, Ursula von der Leyen, head of the European Commission, attended the meeting with Macron. She's very hawkish on China. And Europe announced this investigation into subsidies for the Chinese EV market in September last year. There is a very, if Macron still delivered hard messages, perhaps trying to hold a little bit more of the centre ground in terms of the grander statesman engagement with China, Ursula von der Leyen was there to deliver the blunt message of, if you are subsidising and carrying out what we see as anti-competitive practices, we're not going to put up with that.
Now, David, every day here we talk about inflation. This is kind of an interesting case study to watch on how long we're navigating inflation. You talked about the U.S. decoupling or taking steps to decouple from China, which actually does have some inflationary realities associated with it. Yeah. So I guess, if countries that are used to doing significant trade with China are trying to talk tough, that does also raise the question, well, what does that mean for the global economy and things like inflation over the longer term?
Yeah, and this is it. China's investment-led approach means it can do things and does things that other countries can't do. And to your point, this idea of having more made in America, made in Canada, made wherever that's not China is going to come with a price tag. I wrote a piece in the National Post yesterday, whereas I think that at the moment, everybody is a little steady as she goes, particularly in the US election year. I think what's going to be interesting to see is after November, when the election is out of the way, whether it's Trump or Biden, where does this emphasis go? Because the US has been following this path of made in America. But to your point, that is going to have inflationary implications.
And you mentioned it's not entirely clear who is the voice who represents Europe as a whole, but you've got different leaders, including in France and Germany, they're making their case. But even just looking at, for China, the countries they see the biggest opportunity with, like I was just looking at some of Bloomberg's reporting and talking about cooperation with nations like Hungary as well. If you're Xi and you're trying to find your partners within the fabric of Europe, how are you thinking about what you want to achieve on a trip like this?
It's a very deliberately political move to have a visit where you go to one of the leading Western European nations, one of the biggest European nations with France, arguably also, obviously, of course, with Germany, and then you go to Serbia and Hungary, which Serbia is not even in the EU, of course. Hungary is. Hungary is also a member of NATO, but as we know, Viktor Orban's relations with the rest of his European colleagues and indeed the world are very difficult. One of the reasons she has gone to Serbia is to mark the 25th anniversary, of the bombing of the Chinese consulate there during the war, the Kosovo War. There are lots of political moves that are being made by both going to those countries and the things that he's doing there.
And then just a final question for all that perhaps Xi and the Chinese leadership group hopes to accomplish on a trip like this. We mentioned the tensions that exist simply because you have the situation in Ukraine unresolved. If that remains unresolved, does that just by nature become a continuing complicating factor here?
So Europe sees China, rightly or wrongly, as a restraining influence on Putin, or Xi in particular as a restraining influence on Putin. And if we go back to some of the very heightened language around use of nuclear weapons, Europe believes that Xi has been a restraining influence on Putin in that sense, and that's how they're seeing that part of the mix. At the same time as you've still got all of these other challenges, whether they're trade, but also geopolitically outside of Europe, this is the other side of things that complicates that picture.
Nutrien, the world's biggest maker of fertilizer, said demand has been strong in the US and there are expectations for better conditions later this year in Brazil. Of course, investors are hoping for a turnaround in the crop nutrient sector. It has been struggling with falling prices. Our guest says that the company's latest quarter did align with his positive expectations for Nutrien, but there are risks that lie ahead. We're joined by Martin Pradier, equity research analyst at Veritas Investment Research. Great to see you.
Thank you.
So what is your rating on Nutrien right
Buy.
now? You have a buy on it.
Yes.
Does it look like this slump in fertilizer prices is finally ending?
It does look like, if you look at the prices last, 5-6 months, they have stabilized quite a bit. So, but they are much lower than they used to be. So when you look at the results, the potash price was down 37% year over year, and the nitrogen price was down 35% year on year. Now, at this lower price, they make money. The retail did very well, which was a difference than before, and they had much stronger volume. So when you look at potash, the volume increased 30% year on year. When you look at nitrogen, the volume increased 6%, but the costs were down 25% on lower natural gas prices. So that was a big driver. So looking forward, Q2 is the big Q for this company. Almost 50% of the earnings are in Q2.
As they plant the crops, I guess.
Yes, because North America is the biggest market, and that's where they make the most money. Mm-hmm. And so with stable prices, we'll see strong retail earnings, much stronger than the same quarter last year. We'll see probably more profit in nitrogen and phosphate and lower profit in potash because the prices last year were much higher than what they are today.
Why have fertilizer prices come down? I know they spiked after Russia attacked Ukraine, but is the world dealing with oversupply in things like potash right now?
Potash has been an enigma in many ways because, we had Russia and Belarus producing less and the price spiked, but then declined quite rapidly. And part of it is because the farmers can decide how much potash they put into the soil and doesn't impact too much the yield that year. Over time, it does impact. So over time, they will want to, put more potash. But in a given year, they can reduce that, and that reduction was what forced prices down last year. So now we're seeing better volumes at much lower prices.
And when the BHP's giant Jansen mine kicks in, will there be a glut in the market for years?
The market increases every year because there is a growth of 1.5 to 2.5%. Depend of the year. Mm-hmm. So that might be able to absorb part of Jansen production, mm-hmm. But and Jansen will not come all in the same full speed the first year. But yes, it will put pressure for sure.
You do highlight risks to Nutrien, including rail strikes possibly here in Canada.
Yes, that is one of the things. Like the rail strike is probably the one that worries me the most because rail might reduce the volumes or might make the cost of transportation much higher. So that's one risk. The other risk that I was talking about also is the price for potash contract with China is not settled, China and India. Mm-hmm. And last year they settled lower, so they might settle a little bit lower than the previous year. And lastly, the weather. I mean, it rains too much, it rains too little. There is always this variation in the stock, right? Like in the planting season, if the weather doesn't cooperate, you might have less fertilizer input than you expected.
And what did you say about nitrogen? I mean, obviously, nitrogen, people love it when natural gas prices are low.
Well, the companies in North America now are very, very competitive worldwide. Mm-hmm. Because with this low price of gas, nitrogen is 80% of the cost is gas. So with this very low price of gas, they're the most competitive in the world, sort of. They're really low in there. So they will make money. We don't know exactly, depending on the price, how much money, but they will make some money because they are so competitive that they will have positive cash flows.
It's interesting. I think CF, one of the North American players, their boss or the company was quoted as saying, "We think European players, some of them will just go out of business."
Yeah, I mean, that I don't know, but it's true that North America has much lower gas prices than Europe. It's a huge difference. I mean, it's 2 versus 10, 15 in Europe, depending on, it changes every day, but something like that.
Longer term, will they be hurt, though, by these efforts to cut the amount of nitrogen runoff from fields? Will governments get serious about trying to reduce the amount of nitrogen that's put on? I mean, ultimately, if we're going to waste less nitrogen, there'll be a need for less nitrogen.
Yes, they're working in ways of doing that, but the problem is we have not found another way of produce food without the nitrogen. So, you want to increase the price of food a lot.